The Fed announced its much-anticipated plan for tapering while pushing back on calls for rate hikes. But with inflation seemingly here to stay, is the Fed making a mistake? Hi, I'm Griffin of Derivative Logic, here to get you straight to smart. As part of its scheduled policy meeting last week, the Fed announced it will begin reducing the pace of its monthly bond purchases later this month, reducing its current $120 billion a month bond buying pace by $15 billion each month. That's $10 billion in Treasury bonds and $5 billion in mortgage-backed securities. That's a pace that puts it on track to finish the tapering process by mid-next year, essentially ending its efforts to keep interest rates low by being the bond buyer of last resort. The Fed also altered its view on inflation slightly last week, acknowledging that price increases have been more rapid and enduring than it had forecast, but that it still sees the current bout of high prices as transitory. Fed Chair Powell said he expects inflation to keep rising as supply issues continue, but then start to pull back around the middle of next year, right about the time the Fed's tapering efforts conclude. The key takeaway? Fed officials don't envision rate hikes beginning until tapering has ended. Well, for our take, for the Fed, it's still all about jobs and inflation. Details from last week's meeting tell us that the Fed won't entertain interest rate hikes until the jobs market heals further, even though inflation could run hot for months. The Fed is essentially betting on a forecast that the current knots seen in the port system, overseas production, and in the jobs market will all begin to unravel next year, easing price pressures while ultra-low interest rates continue to stimulate demand. We agree with that view. We've held it for weeks now, and it seems that markets are finally coming around to it as well. Before last week's meeting, markets were pricing in 2 Fed hikes next year, the first occurring in June and the other at year's end. Those expectations have shifted a little bit, with markets now pricing in later rate hikes, the first occurring sometime in Q3 of next year. All told, the Fed has now created room for an earlier liftoff in rates if inflation is hotter than expected next year, even if the jobs market recovery lags. We're expecting at least 1 quarter-point hike next year, probably in the fall, with another quarter-point hike probable in December of next year. For the week ahead, with the jobs market recovery seemingly back on track and likely to meet the Fed's lowered bar for maximum employment by next year, attention now focuses on the Fed's other mandate, keeping inflation in check. The next gauge to tell us where inflation stands is this week's release of Consumer Price Index data. We expect it to show price pressures running at the hottest pace in 3 decades. If so, the market's focus will shift to concerns that these higher prices will sour the consumer's mood to spend into the holiday season. From all of us at Derivative Logic, have a great week.